Money Show.
Personal Finance with Warren Ingram.
The Personal Finance feature is brought to you by Sanlam Corporate, taking employee benefits personally, because when you care, everyone benefits. Sanlam Corporate. Well, Warren Ingram is with us now. He's the financial advisor and co-founder of Galileo Capital. Our topic tonight is getting ready for tax season. If you've got questions about preparing for tax season, you want to put to Warren, 011 883 0702 and 021 446 0567. Your voice notes as well, of course, on 072 702 1702. So tax season opens on the 1st of July. And Warren, before I introduce you properly and say good evening, we thought we should just hear a moment from some real experts on the subject. The Beatles on the Money Show tonight. The song is called Taxman. I think you won't be surprised to hear, Warren. Came to Peter, really, in a moment of supreme creativity. I suppose Inspiration. It's a kind of song you want to beat your head to for the next couple of months.
You do, and it's so interesting. It's one of the things that people really want to hear more about. Although none of us want to pay tax, we all want to know a little bit more and making sure that we pay what we owe, but can we legitimately save as much as we possibly can? And so I know it's a painful thing. None of us like doing it, but it is coming, tax season. And I think there's a little bit we can do now just to get ourselves ready. And then when tax season opens, get the filing done and get your return submitted as fast as possible, especially if you think that you can get a refund from SARS. And the only way you can make that process quick is if you're ready and prepared with all the information that they want from you.
Okay, so the first big question is always, because the auto assessment that SARS does, so where you look at your tax return and so much of it is already pre-populated, it's got information already filled in. That's been getting sort of bigger and better. So should you wait for that?
It's one of those things where the answer is yes, but. And the moment I say yes, then the phones go crazy with tax specialists saying, are you insane? And part of that is that obviously they might not have a job. But I think to give credit to SARS that if people have one salary and they contribute to the company retirement fund and they contribute to a medical aid and that's pretty much their life, then these pre-populated auto assessments actually work pretty well. And so I would say you certainly, if your life is very simple from a tax point of view, then you can probably go with the auto assessment. I have to say though, you like anything in life, make sure you check that auto assessment before you just accept it, because there is always the opportunity that someone's made a mistake or that they've missed something. So I sound like I'm sitting on the fence. It's a very good idea for a very simple position, but please always check. No system is perfect.
Okay. Can SARS miss a few things? And if they do, is that bad for you?
Yeah. So what will happen is if you earn, let's say you earn a couple of sources of income. So you might, you might have a main job and a side hustle. And so, some of the income SARS won't necessarily pick up through an IRP5 or something like that. Then you might find that, already that they won't have all the information they need. And then in addition to that, if you're in the unfortunate position where you had a very expensive year from a medical cost point of view, and your medical aid, for example, hasn't covered all of the medical costs, and you have what they call out-of-pocket medical expenses, SARS won't know that. And so you absolutely want to make sure that you're populating that information, because that might limit your taxes to some extent. And equally, if you've made an additional retirement fund contribution, maybe outside of your company retirement fund into your personal RA, just check that it's done, because if it's missed somewhere, again, it'll be a tax saving. And then one which doesn't apply to all of us, but I guess with work from home nowadays is a little bit more kind of widely used now, and that will be if you actually run your home office, and it's something that you do spend a lot of time in. Then there is the ability for people to actually claim some of those home office expenses. So yes, it's not a critique of SARS' system. None of us want to criticize SARS just before tax season opens, but certainly there will be information that maybe isn't known to SARS, and that might be valuable to you to reduce your taxes.
And then the other thing with an auto assessment is you need to check it, right? I mean, machines make mistakes, and you need to check it before you accept it.
Yeah, and be diligent. It's one of those times when just an extra half an hour to an hour of checking your information against what SARS has got, and making sure that everything is correct. If it is correct, then that's fine. Just accept. But if it's not correct, make sure you edit and submit a full return instead to make sure you're getting the most tax saved that you possibly can.
Okay. It hasn't opened yet, but what can we do now? What documents should we be looking at gathering now?
So the most important for most of us will be your company needs to provide you with an IRP5. And this is the one that shows you how much you've earned through the year, how much tax, they call it PAYE, pay as you earn, how much tax has been deducted, and any other company contributions to retirement funds as well. And then, as I mentioned, if you have more than one job, making sure that you've got both of those IRP5s. So I think that's one. Typically that's probably one of the first things we get, and your employer should be giving that to you as soon as to the beginning of July as possible. And then the next one will be from the financial institution. So if you were in the position where you had some money on deposit at a bank, then the bank will need to send you something called an IT3B, and that will show you how much, or show you and SARS how much interest you earned and how much your dividend income you received. And that might be a bank. It'll also apply, for example, to a unit trust company or any other kind of investment platform. And then another one, now we get a bit more complicated, an IT3C, which is what you need if you've sold investments and you might have some capital gains or even capital losses in that situation as well. So those are the main kind of tax forms. But then, if you are contributing to a retirement annuity and to medical aid, then you are going to get certificates from those companies as well. And that's fairly important, especially the retirement annuity one, because the retirement annuity provider is giving that information to SARS and to you. And so if you're not getting an RA tax certificate, it might be that they haven't completed something that, to SARS as well. And that's how you get, probably the biggest deduction most of us will get, the biggest tax saving we will get is to retirement fund contributions. So those are the big starting points, Stephen.
Okay, and you also, and this is where you need to be careful about travel as well, because there's your travel allowance, you can use your car for business. And for that, I mean, this is something I've never kept, Warren, I'm ashamed to say, you need a logbook.
Yeah, it's a pain for a lot of people because it's quite specific. SARS needs to know, your total mileage for the year in the car, and then what proportion of all of that mileage was business mileage, because it's pretty obvious that that you can't necessarily in your personal car only drive 100% of the time for work. Sometimes you're going to be driving for personal use as well, and so SARS wants to know what's the exact mileage that you've done on each trip. So it does become a little bit painful, and then who and what was the purpose. So it's not something that you should be thinking about fudging. You need to have proper data on hand, because that's the kind of stuff that could be checked by SARS. So make sure you've got your logbook ready. Make sure you've got the starting mileage on your car at the beginning of the tax year and at the end of the tax year, and equally keep record of any expenses. Make sure you've got all the documents. If you did spend money on the car maintenance or services, etc., that's important as well. That doesn't necessarily apply to everybody. If you don't get a car allowance or you don't travel for work specifically in generating income, this might not apply to you. But for a lot of people, it is a big expense and a valuable deduction. But just make sure you've got the records. And then for the Good Samaritans, if you do donations to charities that are registered as public benefit organizations, then you are entitled to get what they call a Section 18A certificate, which shows that you made a donation to a public benefit organization, and that's valuable for getting a deduction as well.
We have a question coming through for you this evening on tax season, Warren, on 072 702 1702.
Hi, Stephen and Warren. I just want to ask, if SARS has identified you as a provisional taxpayer, is there a way where you can unclassify yourself as a provisional taxpayer? Because the whole provisional taxpayer thing does not work for me as such, because now I must pay my tax consultant 3 times. I must pay them for the first period, I must pay them for the second period, and I must still do my annual tax return. Can you please clarify? So I feel like it was better when I was just doing one return annual. I think they call it annual, and then I only pay the fees once. Now it's like 3 different fees that I have to pay. I know the other one, they said it's optional. I don't have to do the annual one. I think the one that will begin in July. But yeah, I do it anyway because it's pre-populated.
Such a good question, actually, because I've come across many people who've asked me that question.
Yeah, and the truth is, I'm not clear actually whether you can kind of re-register yourself from being a provisional back to just a normal taxpayer. A lot of the time you become a provisional because you've earned money away from your salary, for example. So let's say you earned rental income or something like that, or you've become a director of a company. So there are a few instances where you are almost obliged to be a provisional taxpayer. But I'm waffling on that one because I can't think I've ever heard of someone switching back, Stephen, from provisional to the other way, unless they've changed jobs or no longer a company director or something. So I don't know that you can voluntarily do it, and there might be someone who can call in to give us a guidance there. But definitely, I'm going to say I don't know.
Okay. Look, I mean, we don't get that very often nowadays. I think there is something to that. We're going to come back in a moment with more from Warren on this, getting ready for tax season, just a little bit ahead of things. 072 702 1702. Your questions for Warren Ingram in Personal Finance this evening.
The Money Show.
Personal Finance with Warren Ingram.
We're talking about tax season this evening, what you need to do to prepare. Warren, we have another question from Brian. Brian's WhatsApped us saying, how does one declare a gambling windfall on your SARS submission? Brian, I don't know if I know anyone who's ever had to do that. How do you do that, Warren?
I wouldn't be advertising that one, Brian. Otherwise, you might have a few friends knocking on your door for a loan there. I actually don't know, Stephen. It's a great question. I've never come across someone in that position. I'm wondering if it's a windfall as opposed to, if you're a gambler professionally, that's a different game. But if it's a windfall, I'm not sure that's going to classify as income. But I'm just going to say I don't know. Again, I think it might be an answer to a lot of questions tonight.
Dinesh has got in touch, by the way, saying how you can deregister as a provisional taxpayer. You apply to SARS, providing you are not earning sundry income. I'm not entirely sure of the definition of sundry, but I presume it's other income. I remember someone saying to me that 80% of your income has to come from one source for you to not be a provisional taxpayer. I'd need to check that.
So I mean, I don't know about the 80%, but the reality is, if you earn a salary and you get, you pay PAYE, or it gets deducted from one source, and that's it, then you're going to be a normal taxpayer. But the moment you earn, let's just say a majority of your income from a few sources, or from a place where PAYE is not deducted, in other words, rent or interest or trading profits, if you're a trader or a speculator or something like that. So the moment you're not deducting the bulk of your tax as PAYE, then you are going to be a provisional taxpayer, and it's not something you can choose the law requires you to be provisional. And as I mentioned as well, that if you're a company director, then again you are a provisional. So unfortunately, if you've started a business, you are going to be a provisional a taxpayer. But if you were running your own business and you earned a lot of interest income and other stuff, and now you've converted yourself back to being an employee at a company, then that would be the way that you could deregister as a provisional and become a normal taxpayer again.
Okay, that makes sense. All right, Warren, for a lot of people, the most important thing about tax season is making sure you get all of the deductions. What are some of the ones that people miss?
So we've spoken about retirement funds. So just to highlight that. So 27.5% of your taxable income. So whether you're earning a salary or you're earning rent or interest, 27.5% of that can be contributed to a retirement fund for you to get a tax deduction. There is a limit, and it's not going to apply to a huge amount of people, but that's limited to 430,000 Rand a year. So that's the first big one, and it's the one that we should really make sure is right on our tax returns, and then your out-of-pocket medical expenses. So just again, that means what the medical aid didn't pay on your behalf, and those might well be a deduction as well, and then. You can to charities. You can get up to 10% of your taxable salary as a deduction when you contribute to a charity that's registered as a public benefit organization, and they give you that Section 18A certificate. So again, if you want to limit your taxes, you can do that up to a maximum of 10% of your taxable income. And then the home office one, this wasn't really a big one before COVID, but as more and more people are working from home, if you run a home office and you're in there for the bulk of the year, meaning, or at least a significant portion of your kind of working week and working year, then you might be able to get a tax deduction there. However, please check the rules around that. They're quite specific, and if it's a home that you own, it does have some long-term implications on capital gains tax benefits as well. So if you are in a home office position, I always think just pay a tax advisor at least for a consultation to see if it's the right tax for you to use the tax break.
What happens with a two-pot withdrawal? So when you draw money from your pot, you have to pay tax on it as income because you didn't pay income on it when you earned it. It was part of the allowance. What happens when you remove some of it?
Yeah, so this is, I guess it's still relatively new for a lot of people. What will happen is that, if you say, I want a portion of my savings pot from my retirement fund, then there should be tax deducted already by the retirement fund on your behalf, and they will look at your previous tax return and see, that let's say your average tax rate was 18% or 20%. And they will then deduct 20% from the amount that you want to withdraw, and they'll pay that 20% to SARS as PAYE, and the balance will get paid to you. And then you'll get an IRP5 to say that this tax has been paid on your behalf. The trick here is that, unfortunately, sometimes that extra money that you've taken out of your savings pot might have pushed you into a new tax bracket. So actually, instead of now being someone who pays tax at 20%, it might now be 22 or 23%. So you will need to be just careful there that you might still actually owe a bit of additional tax. So unfortunately, the retirement fund provider won't know that on your behalf. They can only go on last year's history.
Okay. A big question. A lot of people sort of wonder about this, about whether you should do your own tax or use a tax practitioner. Plenty of people who will advertise themselves as tax practitioners. When should you do your own, and when do you definitely need help?
So just as an example, I'm someone that you would think I've studied all this stuff. I would do my own taxes, and I pay someone to do my tax. And the reason for that is I am a provisional, and sometimes when you're sitting with fairly kind of complex tax stuff where you might be earning some interest. And you're not sure that you're on top of everything, and you don't want to get on the wrong side of SARS, then making sure that you get someone to help you with your tax returns makes a lot of sense to me. if your life is incredibly simple, so let's just say you're earning one salary and you're pretty comfortable with the basic rules that are required of you to, or that you are required to know, and SARS is doing an auto assessment for you, then by all means just check what the auto assessment has done, and perhaps you don't need a tax advisor. But the moment you're a provisional taxpayer and you're not that comfortable with all of the rules and laws around taxes, I think paying someone to help you with your tax return is probably going to be money well spent. That they are certainly going to be a lot more aware of all the deductions that you can legally make, and equally that the legal traps that you might fall into when you might be making an innocent mistake in trying to deduct something that actually isn't right. Nowadays the penalties for making mistakes are quite high, and you can't just claim ignorance. So I think happy to pay for that.
Warren Ingram, thank you so much. Really do appreciate it. A certified financial planner and, of course, co-founder of Galileo Capital.